macro currency signals.
You're looking at the silver market, watching the daily ticks, debating premiums, arguing about supply shortages, celebrating every breakout and panicking at every pullback. But you're missing the big picture. And the big picture is not about today's price. It's not about next month's premium. It's not even about whether silver hits a certain number this year. The big picture is about the structure of the financial system itself. It's about what is breaking underneath the surface while most people are distracted by headlines, narratives, and short-term volatility. For years, investors have been conditioned to think in isolated silos. Stocks over here, bonds over there, crypto in another corner, gold and silver in their own separate box. But that framework is outdated. In a highly interconnected, debt-saturated global system, nothing moves in isolation. Everything is connected through liquidity, confidence, and leverage. And if you don't understand that, you can own silver for the right reasons, but still misjudge the magnitude of what's coming. Let's step back. Over the last decade, we witnessed one of the largest expansions of money supply in modern history. Trillions were created in response to crises, slowdowns, and political pressure. Central banks didn't merely adjust rates, they engineered liquidity. They expanded balance sheets, they suppressed yields, they distorted risk, and in doing so, they inflated asset prices across the board. Before we move forward, if this viewpoint resonates with you, take a second to subscribe and turn on notifications. In an environment like this, being informed in real time isn't just useful, it's strategic. Positioning yourself early rarely feels comfortable. It's usually unpopular, but that discomfort is often where the greatest asymmetric opportunity exists. Leave a comment below and tell me where you're watching from and what time it is where you are. This conversation isn't confined to one country, one currency, or one market. It's unfolding on a global scale. And when you start to see how widespread these signals are, it becomes clear that this story is much larger than any single headline. Now, let's return to what's quietly shifting beneath the surface. Stocks surged, real estate exploded, crypto entered the mainstream. Even speculative tech with no earnings commanded massive valuations. It felt like a new era, but it wasn't a new era. It was the consequence of artificially cheap money. Now here's where silver holders start to miss the big picture. Many believe silver's moment will come simply because inflation exists, or because industrial demand is rising, or because supply is tight. Those factors matter, but they are secondary to the structural issue, sovereign debt instability. The real story is not inflation alone, it is debt saturation. Governments around the world accumulated obligations at a pace that would have been unthinkable a generation ago. Deficits normalized, emergency spending became permanent spending, and bond markets, once considered the bedrock of safety, quietly became the most important pressure point in the entire system. Most retail investors focus on stock charts, but the bond market is far larger. It determines the cost of capital. It determines currency strength. It determines whether governments can fund themselves without crisis. When bond markets are stable, the system hums along. When bond markets fracture, everything changes. And that fracture has already begun. Yields have risen in ways that challenge decades-long assumptions. Liquidity injections have become more frequent. Interventions are framed as stabilization, but stabilization itself implies stress. When authorities must constantly step in to maintain functioning markets, you are not witnessing strength. You are witnessing fragility masked by policy. Now ask yourself, what happens when confidence in sovereign bonds erodes? For decades, bonds were the safe asset. They yielded modestly, but they were trusted. Institutions parked trillions there because safety mattered more than upside. But when inflation erodes purchasing power and yields fail to compensate, safety becomes questionable. And when safety becomes questionable, capital begins to migrate. Silver holders often focus only on retail buying spikes. They celebrate coin shortages. They track mint delays. But the real driver of a major silver revaluation will not be retail stacking. It will be institutional capital, searching for monetary refuge. That's the big picture. When large pools of capital begin to question bonds, they don't immediately jump into volatile equities. They look for alternatives with history, liquidity, and tangible backing. Gold has always been first in line. Silver, because of its dual monetary and industrial role, follows with leverage. But here's the nuance most people miss. Silver does not move because of excitement. It moves because of distrust. Gold responds to systemic fear steadily. Silver responds violently once fear crosses a threshold, and that threshold is tied directly to confidence in debt markets. We are entering an era where government debt is no longer abstract. It is visible. Interest payments are consuming larger portions of budgets. Refinancing risk is increasing. Currency dilution is no longer theoretical. It's measurable in purchasing power decline. The money supply expansions of recent years are not temporary anomalies. They represent a structural shift in how crises are handled. Print first, justify later. Silver holders who only look at price are missing this. You should not be asking, why hasn't silver exploded yet? You should be asking, what must break for capital to reprice monetary metals aggressively? The answer is not retail demand. The answer is bond instability combined with currency erosion, and we are closer to that tipping point than most realize. Now, layer on another dimension, speculative excess in alternative assets. Over the past several years, massive capital flowed into digital assets under the narrative that they were the new monetary hedge. A decentralized alternative. Digital scarcity replacing physical scarcity. That narrative attracted generational belief in institutional allocation. But when speculative bubbles break, they do more than reduce price. They damage confidence, and confidence is everything. When an asset marketed as digital gold experiences structural breakdown during a period of rising sovereign stress, capital takes notice. If the hedge fails to hedge, the premium evaporates. And when that premium evaporates, capital rotates. This is not about mocking innovation. It's about understanding capital behavior. Speculative capital seeks growth. Defensive capital seeks preservation. When growth narratives falter in unstable macro conditions, preservation assets benefit. Silver holders who ignore capital rotation dynamics will underestimate the speed of revaluation when it begins. Because when large funds shift allocations, they don't buy a few coins. They buy futures, ETFs, mining equities. They move size. And in a relatively small market like silver, size moves price aggressively. But here's the other side of the coin. Silver is volatile, painfully volatile. It punishes impatience. It shakes out weak hands. It spikes and collapses. It lures in late buyers and tests early believers. That volatility causes many holders to focus on short-term moves instead of structural positioning. You have to think differently. The purpose of holding silver in this macro environment is not to trade every swing. It is to position yourself against systemic currency dilution and sovereign debt instability. If the system stabilizes sustainably, silver may grind higher slowly. But if bond confidence cracks meaningfully, silver will not grind. It will erupt, and eruptions do not give polite entry points. Now consider the industrial angle. Silver demand from technology, energy transition, electronics, and defense applications continues to grow. Supply growth has not matched that pace consistently. That creates structural tightness over time. But industrial demand alone does not create a monetary revaluation. It creates a floor. The explosive upside comes when monetary demand collides with constrained supply. That collision requires macro stress. Look at historical episodes of aggressive silver moves. They coincide with monetary uncertainty, inflationary surges, or systemic distrust. They are not random. They are not purely technical. They are psychological and structural. We are building toward that kind of environment. Debt loads are historically extreme. Monetary authorities are trapped between inflation control and financial stability. Raising rates pressures bonds, lowering rates pressures currency. Intervening distorts markets. Not intervening risks collapse. There is no painless path forward. And in such environments, tangible monetary assets regain relevance. Silver holders who think this is about quick profits are missing the gravity of what's unfolding. This is about a transition phase in global finance. A shift from unquestioned trust in paper assets to selective trust in tangible stores of value. That shift does not happen overnight. It builds through cracks, through small crises, through liquidity scares, through quiet interventions that become less quiet over time. Watch the bond market more than you watch silver's daily candle. Watch currency purchasing power more than you watch social media hype. Watch institutional allocation patterns more than you watch coinshop anecdotes. The big picture is not about whether silver moves $5 next week. It's about whether sovereign debt remains unquestioned for another decade. If it does, silver may appreciate steadily but not explosively. If it doesn't, silver's repricing could redefine what most people consider possible. And here is the final point for this first part. Belief systems are shifting. Younger investors who once believed in purely digital scarcity are confronting volatility that challenges conviction. Older investors who trusted bonds are confronting yields that fail to protect purchasing power. Institutions that relied on traditional portfolio models are questioning the viability of old allocations. When belief shifts, capital shifts. And when capital shifts in a debt-saturated system with limited tangible monetary alternatives, the moves can be historic. Silver is not just a metal. It is a pressure valve for distrust. You can own it casually. You can trade it tactically. Or you can understand it structurally. If you choose the structural view, you stop obsessing over noise and start watching fault lines. The fault lines are forming, and most silver holders are still staring at the surface, unaware of the tectonic pressure building beneath their feet. That's the big picture you cannot afford to miss. Now let's take this even further, because understanding the debt problem is only half the equation. The other half is psychology. Every major monetary shift in history has required two things: structural stress and public realization. Stress can build for years beneath the surface, but until perception changes, price doesn't fully reprice. Silver holders often assume that because the fundamentals look strong, the move should already be here. But markets don't move on fundamentals alone. They move when perception catches up to reality. Right now, we are in the transition phase. Inflation has eroded purchasing power, but many still believe it's temporary. Bond markets have shown instability, but most still believe central banks can manage it. Government debt levels are extreme, but the public assumes it's sustainable because it has been sustained so far. That's not confidence, that's inertia. Inertia works until it doesn't. The key variable is trust. Trust in bonds, trust in currency, trust in institutions to control outcomes. When that trust weakens incrementally, capital adjusts slowly. When that trust breaks suddenly, capital moves violently, and silver does not wait politely during violent capital shifts. Most people underestimate how small the silver market is relative to global capital pools. Pension funds, sovereign wealth funds, large institutions, if even a fraction of their allocation models shift toward tangible monetary hedges, the impact on price is not linear. It's exponential. But here's where many silver holders still miss the big picture. They assume silver's rise will be comfortable. It won't be. If silver explodes because of systemic instability, it will likely coincide with broader market stress. Stocks could be volatile, bonds could be unstable, liquidity could tighten before it expands again, headlines will not feel celebratory, they will feel uncertain. Silver's true bull phases are born in discomfort, and that discomfort is tied to the bond market more than anything else. If sovereign yields spike beyond what governments can comfortably service, intervention becomes inevitable. Intervention means liquidity. Liquidity means currency dilution over time. Currency dilution pushes capital toward tangible stores of value. This is not theoretical. It's mechanical. But here's the danger. If you only focus on silver's upside without understanding the systemic trigger, you may misinterpret pullbacks as failure. You may mistake consolidation for weakness. You may get shaken out before the real move begins. Silver does not move in straight lines. It compresses. It frustrates. It tests conviction. It rallies sharply, then retraces deeply. That volatility is not a flaw. It's a feature of a small market, absorbing large capital shifts. And then there's supply. Years of underinvestment in mining. Environmental constraints, declining ore grades, and rising production costs have limited rapid supply expansion. Industrial demand continues quietly in the background. That creates structural tightness. So when monetary demand accelerates on top of industrial demand, you don't get balance. You get imbalance. Imbalance is where price discovery becomes violent. But none of this matters if sovereign debt remains unquestioned. That's the hinge. If governments manage to suppress yields indefinitely without triggering currency distrust, silver's move will remain controlled. But if suppression fails or inflation reaccelerates in response to intervention, the repricing window narrows quickly. And here's the final layer: generational wealth transfer. Younger generations are inheriting not just assets, but debt-laden systems. They are more skeptical of institutions. They are more aware of currency debasement. As wealth shifts generationally, allocation preferences may shift with it. Tangible assets may regain prominence, not out of nostalgia, but out of pragmatism. Silver sits at the intersection of monetary history and modern industrial necessity. It is ancient and contemporary at the same time. That dual role is powerful in a transitioning system. But again, and this is critical, the trigger is not hype, it's trust erosion. Watch trust, watch bonds, watch currency purchasing power. Silver is not just a trade, it is a barometer of systemic confidence. And when that confidence fractures in a meaningful way, silver will not whisper. It will move in a way that forces even skeptics to pay attention. Most holders are watching the chart. You should be watching the foundation beneath the system that gives that chart meaning. That's the big picture. So if you own silver, don't own it blindly. Don't own it because of social media excitement or short-term predictions. Own it because you understand the structural shift unfolding in global finance. Own it because you recognize that debt saturation, currency dilution, and bond instability are not temporary headlines. They are defining features of this era. When trust in paper wavers, tangible value reasserts itself. And when that moment arrives, it will not be subtle. The question isn't whether silver can move. The question is whether you understand why it would, and whether you're prepared before everyone else finally sees the same big picture.